You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well for this Retirement Friday. So today we are doing a double whammy. So we're talking about retirement, but we're talking about retirement REITs. So retirement and investing all in one episode. Over the past few quarters, maybe it's been like 2 years or so, retirement REITs in Canada are doing incredibly great. So Chartwell, CSH.UN.TO and Sienna Living, SIA.TO has been doing very, very good. Actually, Chartwell over the past 3 years, total return is 91%. So that's kind of crazy, right? That's probably enough to be put on your radar. So we're going to talk about both today. We're going to talk about what's going on as of late, why they're having so much success. We're going to talk a little bit more about why I didn't like that much those REITs over the past 2 years and what's coming up for the future. So let's get started with Chartwell, SCH. So relatively good size REIT, actually, over 5 billion in market cap, which is pretty decent. I mean, we're like 5.1 right now. So of course the stock price, the unit price has skyrocketed as of late. But yeah, so decent size, 139 properties, mostly held in Ontario, BC, Alberta, and Quebec. And one thing that, I mean, wow, 3.33% yield, but no dividend increase. Even though the dividend triangle looks good now, they have stopped increasing their dividend following the COVID crisis. So before that, and it's similar to Sienna Living as well. Actually, Chartwell before COVID, I kind of like the stock. This REIT was showing a decent dividend triangle with some dividend increases, distribution increase because it's a REIT. So that was pretty good. And then everything kind of like fell out. But recently, the past results over the past few quarters have been quite impressive. Strong revenue growth, strong FFO per share growth as well. So we're talking double-digit revenue growth, actually, because it's fueled by two major growth vectors. The first one, growth by acquisition. So this year, for example, they've made already 0.7 billion, so $700 million of acquisition so far this year. And that, of course, boosted revenue by a wide margin. FFO per share up 5.1% last quarter, so still pretty good. And the other growth vector was higher occupation rate. So right now, almost at 92%. The target for the year end is 95%. So not only the REIT is growing by acquisition, but it also increased its occupation level, which is, of course, a very good sign, because when you're at 95%, as like that's the target right now, and management said that they were on pace to reach that, well, it means that your expenses are being covered by a lot, like many more tenants. It's easier to generate profit, of course, and you have a little bit more room as you generate more cash flow. For Sienna Living, it's a little bit smaller, so 1.7 billion market cap versus 5, but offering a 5% yield. So depending if you're looking for a little bit more of a stability with a lower yield and like more diversification with Chartwell, you can go with Sienna Living for a smaller cap. Anything under 2 billion, I would call that a small cap. So this one is definitely a small cap, but offers a better yield. The numbers are a bit like weaker than Chartwell. But we have like very strong occupancy rate, above 90% for most of their their property types. They run 94 properties. Again, mostly in Ontario, actually. So they do have like some BC and Alberta, but mostly in Ontario and Quebec. And then you have AFFO payout ratio of 86%, so which was a little bit lower than 70% for Chartwell. So now we have room for distribution increase, which hasn't been the case for a while, though. So, as I said, since COVID, nothing was moved in terms of distribution. And Sienna Living is also growing through acquisition. So, they have similar business model, similar types of numbers. Chartwell are a little bit better if you look at the dividend triangle in terms of size, in terms of payout ratio as well, and the growth is a little bit bigger. So I kind of like this one, but both are rated the same at DSR. So they got a pro rating of old, so a 3 out of 5, and a dividend safety score of 2 because they have not increased their dividend for the past 5 years, which means that each year your income is actually getting hit by inflation. So here's the thing. Before COVID, those were pretty decent REIT. Actually, kind of REIT with a good business model and everything. So I kind of like them. They were increasing their dividends, so that was good. I never held one or the other, but when COVID happened, that pushed them very hard. So the first problem is, of course, they had to increase safety, so they were operating now with higher costs, and on top of that, they got kind of like double wham here because like the expenses were rising, but the occupancy rate, of course, decreased. So you have less people generating revenue, but your costs are higher. So that's not a good recipe. And that's why it took forever to recover. So don't make the mistakes thinking that those two REITs are on fire. They actually took forever to recover and finally showed some interesting and trend after 2024. So it took them a full 4 years to recover from COVID in terms of stock price, and then finally offering something for investors. Now, after COVID, now we have like higher occupation rate. We have like a lot of like bullish sentiment around those two and probably the entire industry. But my question would be, for how long? How long in a sense where like one of the major risks for any type of REITs is actually oversupply. If you have like too many apartments, if you have too many industrial properties, or in this case, if you have like too many senior housing and housing with like a senior home with care, if you have too many of them and then occupation rate starts going down, you're going to have a problem because the fixed cost of operating those properties will not go down, actually kind of like tend to go higher up with higher interest rates, with like a lot of like labor that you have to pay and inflation. So it's kind of hard to maintain if you have lower occupation rates. So right now it's not what's happening, but I'm just thinking, well, in the coming years, the demographic in Canada is not on their side, in the sense that, yes, we have a lot of people that will go into senior home, but after that, it's going to go the other way around because we're now pretty much at the point where we have more older people than we will in like 20, 25 years from now. So I'm not convinced it will continue to grow at this pace moving forward. So right now it's going well, but I'm just thinking about maybe in 10 years from now, what's going to be. And of course, a lot of investors will tell me, but Mike, 10 years is like so long term in my mind. I'm like, yeah, well, on my side, it's not that much. Keep in mind, it took them forever to recover this time, and they still haven't increased their dividend. They have room now to do so, so I would not be surprised to see them increase their dividend either in 25 or in 26. They seem to be very focused on acquisition right now, and again, that's a double-edged sword, right? So on the one side, it's great to boost revenue and FFO per unit right now, but over the long run, will they get into a world of oversupply? Again, it's going to be a little bit harder. So my advice here is to not necessarily get hype about what just happened over the past 2 years on the recovery, but mostly focus on the business model today and ask yourself if there's more room to grow. Maybe there is. I'm not saying it's not, and I'm not telling you what to do here. It's, remember, just for entertainment purposes only. But I still have personally this concern around the business model. I'm not saying it's a bad thing. Actually, it's doing well as of late. So, and they're definitely show a lot of momentum. But I think there are like other better investment that you can find of. But I mean, that's just my opinion. If you are looking for more income product for young retirees, you can download our 20 income focused product guide at retirementloop.ca/income. So it's retirementloop.ca/income. You register there and you're going to receive our 20 income focused product. We have reviewed all of them in an unbiased way, so showing you pros and cons for all of those so you make the best decision for your retirement plan. So, hey, Moose, that's enough for today. We're going to talk again on Monday. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.